Hello, everybody. What's going on? So, today we have to have a real talk, a state of union for one of the most talked about names in the fintech SOFI. Now, before we dive into the charts, I want to ask you a few things that have been keeping me up at the night. Why is that while the retail market is panicking, the CEO is opening his personal checkbook to buy more? How is a company that just hit 10 consecutive quarters of profitability still being valued like a falling regional bank? And the biggest questions of them all, is the AWS of fintech dream actually dead, or are we just standing at the base of the most misunderstood growth story of the decade? Let's find it out. I have got this presentation ready. Let's watch it together.
Imagine a company growing its core business by an astonishing 40% year over year, adding millions of new users, and doing it entirely without the massive, crippling overhead of its legacy peers. Now imagine Wall Street throwing a collective fit, burying the stock, and leaving investors basically threatening to jump ship. Welcome to today's deep dive.
It really is. It's the ultimate paradox of market sentiment versus structural execution. Today, we are unpacking a really fascinating, highly debated set of analyst notes and financial commentaries surrounding SoFi's recent quarter. Because beneath all that headline frustration, there is, a literal masterclass in market mechanics taking place.
Right, and our mission today is to grab a flashlight and walk right into that disconnect. So if you follow the fintech space, you know this central conflict we're pulling from our sources today really comes down to one massive question. Is SoFi a broken thesis, or is it a misunderstood, tightly coiled spring?
Yeah, that's the big debate. And to figure that out, we really have to look at what this company was supposed to be versus what this recent quarter actually delivered. The original appeal, the narrative that brought that massive premium valuation, was that SoFi was building the AWS of fintech.
Right, the Amazon Web Services of the financial world. The premise was that they wouldn't just be, a consumer-facing bank. They would provide the invisible underlying tech infrastructure that the rest of the financial market runs on.
Exactly. You don't just sell the books. You own the servers everyone else uses to sell their books. For SoFi, that meant their tech platform segment, specifically those acquisitions of Galileo and Technisys, was supposed to be just exploding with high-margin software revenue.
But the reality of this recent quarter kind of hit that narrative like a brick wall, didn't it? Wall Street looked at the tech platform revenue, and it had essentially flatlined.
It did, yeah. The revenue diversification Wall Street was modeling for simply wasn't there. But this is where we have to look past the top-level number and really examine the underlying mechanism, because the source data notes that they actually brought on 13 new enterprise customers to the tech platform side this quarter.
Which sounds incredibly bullish on the surface. 13 new enterprise clients is huge. Okay, let's unpack this, because I want to try and explain the disconnect here. The immediate revenue impact from those 13 massive clients was practically zero.
Right, zero recognized revenue up front.
So Wall Street sees 13 contracts signed and no money hitting the cash register, and they completely panic. But that panic ignores the reality of how enterprise B2B integration actually works.
That is the crucial missing piece. Enterprise tech sales aren't like signing up for a consumer software subscription. You don't just pay your $20 and start using it that afternoon. When you sell a core banking platform, there's like an 18 to 24 month integration pipeline.
Because you are migrating entire institutional ledgers. You don't just flip a switch. You have to transition millions of user accounts, route payment APIs, and run all this parallel testing to ensure the balances match to the penny.
Exactly. They sign the contract today, but they don't start paying that consumption-based revenue until their own customers are fully migrated onto the platform next year. Wall Street is looking at today's cash register, but SoFi is building tomorrow's pipeline.
And in the meantime, while that pipeline is being built, traditional banking, lending and financial services is currently doing all the heavy lifting for SoFi's balance sheet.
Yeah, lending is completely carrying the team right now.
And that leads directly to the bear case outlined in our sources.
Yeah.
Wall Street is looking at the balance sheet and saying, well, we didn't price this to be a bank, we priced this to be a tech disruptor.
Right.
The source material argues that if investors just wanted exposure to traditional lending, they could have got a legacy giant like Citigroup when it was trading at a massive discount to its tangible book value.
It's a really common critique. And for context,
SOFI Bank
tangible book
core
value is essentially what a bank would be worth if you liquidated all its hard assets today and paid off all its liabilities. Legacy banks often trade near or even below that number, making them, classic value plays.
Right, so the argument is, why take on the volatility of a new fintech if it's ultimately just going to generate its profits through traditional lending? It feels like hiring a brilliant, highly specialized software engineer, and when you check in on them a year later, they're just like processing payroll.
That's a fair comparison, but what's fascinating here is that it misses a massive structural reality. Yes, the market is trying their absolute hardest to pigeonhole SoFi as just a bank, and they want to slap a traditional, boring banking multiple on their stock price.
You really do.
But if we're going to call them a bank, we have to respect the actual math of how this specific bank operates.
And the math is frankly staggering when you actually look at it.
It is. This is a bank growing its top line at roughly 40%. They now have over 14 million members. And the structural advantage that a bank critics willfully ignore is their operational leverage. They have a cost structure completely free of physical branches.
Oh, absolutely. No brick and mortar commercial leases and expensive downtown real estate. No thousands of local branch managers to pay. No utility bills or security infrastructure for corner bank locations.
Right. Think about the legacy banks you just mentioned. A giant, like Citigroup, Bank of America, is growing at maybe 15% on a spectacular day. SoFi is scaling at 40%.
Wow.
You simply cannot find another financial institution with 14 million members expanding at that speed. So, Wall Street can call it a traditional banking model if they want to, but it is the most efficient, hyper-scaling digital bank the sector has ever seen.
I hear that, and yeah, the core business is undeniably robust. But it doesn't solve the behavioral anxiety for the investor, If the tech side isn't generating immediate revenue, and Wall Street is strictly valuing them as a bank, what is management actually doing to force a re-rating?
Right, because you can't just keep promising the AWS of fintech narrative in investor presentations if the numbers don't reflect it.
Exactly. And that brings us to the operational pivot our sources are focused on. Management is actively consolidating and rebranding their entire tech offering under one unified umbrella, calling it SoFi Technology Solutions.
Let's unpack the architecture of that for a second. Galileo historically handled the payment processing and card issuing, while Technisys was the cloud-native core banking system. They're basically knitting those acquisitions together into a single, cohesive cloud core.
Right. And here's where it gets really interesting. They are gearing up for something they call the first scale launch. By July, SoFi intends to complete the implementation of this new unified core tech platform. But the critical detail here is that they are doing it using SoFi Bank itself.
They are essentially eating their own cooking. They're migrating their own massive banking infrastructure onto this new tech stack to act as their own ultimate case study.
It is a strategic masterstroke in theory. Historically, SoFi's tech platform has operated as a vendor for smaller fintech startups. But the stated goal, the real revenue driver, has always been to become the backbone for major financial institutions, the legacy Tier 1 banks.
Exactly.
But I have to push back on this strategy for a minute, because from an operational standpoint, this seems incredibly dangerous. Testing this massive, newly consolidated tech stack live on your own US regulated bank is not like beta testing a new app interface.
No, not at all.
When we talk about a core platform, we are talking about the central nervous system of the bank. It settles every deposit, calculates interest overnight, interfaces with the Federal Reserve.
The stakes literally could not be higher.
Right. If there is a migration glitch, it doesn't mean a web page loads slowly. It means millions of accounts show the wrong balance. Regulators don't care that you're a disruptive fintech trying to prove a point. Doing this right when Wall Street is already punishing your stock seems like walking a tightrope without a net. If they stumble, the core revenue engine stalls.
Oh, it is absolutely a tightrope walk. You are swapping out the engine of a jet while it's in mid-flight. But we have to look at why this gamble is necessary. The sales cycle for a legacy Tier 1 bank to change its core processing system is notoriously long and fraught with institutional paranoia. You don't convince a century-old bank to rip out its plumbing on a whim.
Because the career risk for the banking executive making that decision is immense. If they buy software from a startup and it crashes, that executive is fired immediately.
Precisely. They need undeniable, bulletproof evidence that this tech stack works seamlessly at massive scale under strict regulatory scrutiny. By executing this migration internally in July, SoFi hand delivers the ultimate proof of concept. They fundamentally de-risk the product for their future clients.
So the pitch changes completely. They can walk into a request for proposal meeting with a legacy bank and say, hey, we aren't just selling you theoretical software. We run a top-tier US regulated bank on this exact platform, handling millions of complex transactions a day, and we grew our member base by 40% while doing it.
Yes, and if they successfully make that transition from being a vendor for small startups to the infrastructure provider for major legacy institutions, that is how the coveted AWS Tech Premium multiple returns to their valuation. They're building a massive operational insurance policy internally, so they're prepared for a major external sales push in the second half of the year.
Which creates a massive quantifiable disconnect in the market right now. We have this gap between what the company is actually building beneath the surface, this unified tech backbone, and how the market currently prices them based solely on their lending book. Let's look at the actual numbers our sources provide.
Sure. So the consensus estimates from Wall Street analysts are projecting that by 2028, SoFi will generate between $1.02 and $1.12 in earnings per share.
So roughly $1.10 in EPS 4 years from now. If we reverse engineer that projection, what does it imply about Wall Street's view of their growth?
It equates to roughly a 30% compounded annual growth rate over the next 4 years. Now, 30% is still excellent for a financial institution, but the market is pricing them as a very successful traditional bank, emphatically denying them the tech premium that software as a service companies command.
But here is the critical delta. Wall Street is projecting a 30% growth rate, but SoFi's management is officially guiding for 38 to 42% growth. That is a massive gap in expectations over a multi-year compounding period.
And that gap is where the alpha lives. Wall Street has been burned by the lofty promises of fintechs before. They are in a strict show-me phase. Analysts are refusing to build the tech platform's potential into their models until they see actual enterprise contracts generating recognized revenue.
So what does this all mean? Let's do the math on what happens if management is right and Wall Street is wrong. We can look at the PEG ratio, right? The price to earnings to growth ratio. It's a metric that contextualizes a stock's valuation by factoring in its expected earnings growth. Right now, SoFi is trading at roughly 15 times its projected 2028 earnings.
Right, so you take that price to earnings multiple of 15 and you divide it by management's stated growth rate of roughly 40%.
15 divided by 40 gives you a PEG ratio of roughly 0.37. To put that in perspective, in a broader market where a PEG ratio of 1.0 is generally considered fair value, 0.37 is a screaming fundamental discount.
It really is. It indicates the stock is heavily mispriced relative to its own internal execution. If SoFi simply hits the high end of their own guidance, we aren't talking about a miraculous, unexpected blowout, just their own stated trajectory, the current share price is going to look like an absolute gift in hindsight.
But waiting for the broader market to recognize that gift creates a severe behavioral trap for the retail investor. It requires immense patience, and our source material spends a lot of time addressing the psychological warfare of holding a fundamentally discounted stock while the rest of the market is just in a frenzy.
Oh, absolutely, because while you're sitting around waiting for SoFi's July pivot and tech platform integration, the broader market is losing its collective mind over AI.
The temptation to chase the AI infrastructure boom is a very real, very dangerous dynamic.
It tests your discipline daily. You're holding SoFi, watching the ticker stay flat or dip due to macroeconomic fears, and meanwhile you look at stocks like Micron, Nvidia, or specialized GPU neocloud providers like CoreWeave, and they are going parabolic.
It's like leaving a structurally sound, deeply discounted commercial real estate investment to go bid on a hyped-up piece of digital art just because the price went up yesterday. The temptation to abandon your fundamental thesis to chase the momentum is overwhelming. It's like standing in a slow-moving checkout line at the grocery store, just agonizing while you watch the AI lanes zoom by.
Yeah, that's exactly it. And that behavioral flaw is exactly how retail investors get chopped up in volatile markets. The psychological toll of temporary underperformance makes them abandon their core strategy.
The source commentator addresses this tension directly. They actually agree with the AI thesis. They note that the AI memory cycle for a company like Micron is likely going to last 3 to 5 years, and they're actively buying into that space. But they draw a very hard line. They are using new cash to buy it. They explicitly warn against cannibalizing a core SoFi position to chase the shiny object.
There is deep historical market logic to that warning. If you sell your SoFi shares right now, Just because the tech revenue is flat for one quarter and you're tired of waiting for the integration pipeline, you are selling at the point of maximum frustration.
And maximum frustration is almost always the exact bottom of a stock cycle.
Worse than that, honestly. By capitulating and selling at maximum frustration, you aren't just locking in a loss. You are actively funding the institutional buyers who have been waiting on the sidelines to snap up those discounted shares before the narrative shifts. This ties directly into the coiled spring theory that the source outlines.
Let me make sure I'm explaining the coiled spring mechanics correctly. A coiled spring implies stored kinetic energy. The market is artificially compressing SoFi's valuation multiple right now because of macroeconomic fears, like interest rates staying higher for longer and the delayed tech revenue. But once those pressures lift, the snapback isn't a gradual recovery, it's violent.
Yes, and the triggers for that uncoiling are highly specific. The moment the macroeconomic environment shifts, for instance, when the Federal Reserve officially puts rate cuts back on the table, which drastically lowers SoFi's cost of capital and immediately spurs their lending margins.
Or the moment one of those massive large financial institution RFPs actually signs and SoFi announces a top-tier legacy bank is officially moving their ledger to the SoFi Technology Solutions stack.
Exactly. The stock won't just slowly tick up a few percentage points, it will fundamentally re-rate. The entire analyst community will have to recalculate their models overnight to include the AWS tech premium they've been completely ignoring.
To understand how quickly sentiment can pivot, we can look at a recent historical example of a broken thesis that violently corrected. Look at Meta in 2022. The market decided the metaverse thesis was broken. They dumped the stock, calling it dead money. But the core advertising business was still generating billions in free cash flow. When Wall Street finally realized the core company was fundamentally sound, the stock didn't just recover, it exploded upward like a coiled spring.
If we connect this to the bigger picture, this raises an important question. As an investor, you have to develop the analytical rigor to identify the difference between a broken thesis and a broken company.
A broken company is structurally flawed, their margins are collapsing, they're hemorrhaging users, their underlying product is actively losing market share.
Right. A broken thesis, however, simply means the market's timeline for a specific narrative and the company's operational timeline are temporarily out of sync. SoFi is executing. The core digital banking business is adding millions of members. They're actively winning customers away from giants like JP Morgan, and more importantly, they are retaining them. The fundamental business is highly robust.
Yeah, the grand tech platform story is just taking an 18-month integration cycle to manifest, which is longer than impatient investors are willing to wait. So if we pull all of this together, why should you care about this specific set of analyst notes?
It's a fair question.
Because what we've unpacked today is a masterclass in evaluating structural math over market mood. It is about training yourself to look past the quarter-to-quarter noise and the headline frustration. Can you identify a hyper-efficient cost structure? Can you hold your ground and trust your PEG ratio calculations when the broader market is chasing momentum?
It requires a level of emotional detachment that is very difficult to cultivate, but it is the defining characteristic of successful long-term capital allocation.
But as we wrap up this analysis, there is one final, somewhat provocative implication hidden in the source material that we haven't fully untangled.
Yeah, we spent a lot of time discussing how SoFi is using its own bank as a live case study. They are perfecting their unified tech stack during this July pivot so they can turn around and sell that exact infrastructure to the massive legacy institutions.
Right. They are proving it works so they can license it to the very competitors they are currently taking market share from.
Think about the long-term strategic paradox of that goal. The primary reason SoFi is currently able to win millions of customers away from legacy banks is because those legacy banks are weighed down by clunky, outdated digital experiences and slow processing. If SoFi is wildly successful and they sell the exact software that makes their own apps so fast and user-friendly to the old guard, are they essentially arming the enemy?
Wow, you upgrade the legacy banks, thereby erasing your own competitive digital moat.
Exactly. By curing the technological disease of the traditional banking sector, does the AWS of fintech eventually make those legacy institutions far more competitive against digital disruptors like SoFi itself?
That is a fascinating architectural dilemma. You build the ultimate weapon, but to monetize it, you have to sell it to your biggest rival. It's a reminder that the landscape of technological disruption is never a clean binary equation. It's a complex ecosystem where solving one problem often engineers a completely new set of competitive complications, something to consider as you watch this structural narrative play out in the quarters to come.
That was quite a report. In the end, I would just like to say that keep your eyes on the macro side. With the new Trump IRA executive order floating around for 2027, there is a massive push for digital first retirement account. SoFi is perfectly positioned to capture that Gen Z and millennial weather transfer. Look, RSI is sitting near 30. We are in oversold territory. Historically, when SoFi hit these levels and Noto start buying, a reversal isn't far behind. I'm not here for that 5% move. I'm here for a re-rating of a tech multiple. I'm holding. Noto is buying, and numbers are screaming growth. What you guys are doing? Are you following the CEO or are you following the fear? Drop your thoughts below.